Good afternoon, friends. I am Dinesh from Fundamental Research. Will present the key points regarding the Union Budget for 2012-13. On May on the date of March 16, government would be presenting the budget amid very high expectations. The economy is showing a downward trend, so government is expected to take some decisive action, and probably this would be the last chance for government to take some measures to boost the economic growth. However, the budget would be focused around three key points. Firstly, being the fiscal consolidation. Government has already overshot on its fiscal deficit target, so that will be the key thing that market would be watching. Apart from that, government will also be looking to revive economic growth, which is actually trending down. Then government will also be looking at boosting the forex inflows that could provide some sort of stability to the currency. Now, coming to the fiscal consolidation, that is the figure which government will be watching very anxiously, because actually the target was set 4.7% for FY12. That government has actually ended up stretching the target to about 5.5% for the it would be about 5.5% for the current year. So going ahead, given the tight expenditure budget, due to very high crude prices, and also due to government's focus on the social schemes, the expenditure would be quite sticky. So that will make managing the fiscal deficit quite challenging. Coming to the overall revenue side, also government is also not very comfortably placed. The tax revenues are falling due to slowing of economy. Apart from that, the non-tax revenues has also not materialized due to sluggish market conditions. Now, going ahead in the budget, we expect the dependence on non-tax revenues to remain high. Government may resort to divestment or spectrum auctions to garner non-tax revenues, whereas on tax side, government may try to tinker with the existing customs duty, excise duty, or import duty to raise indirect taxes. Other point that market would be watching is the government borrowings, since the government normally bridges the gap between the expenditure and income via borrowings. So borrowings, which have been quite high for the current fiscal, market would take cues from that. If the borrowings are actually lower than the for next year are lower than the current year, it would be taken positive for the market. But in case if it exceeds the current year, market will probably not take it as a as a positive sign. Now, apart from that, to revive economy, government would also initiate some steps, such as boosting the investment in the key areas which are capital deficient, such as infra, etc. Apart from that, it will also try to extend the public-private partnership in other areas. Apart from removing the bottlenecks in the flow of investment into the economy, it will also look at reducing the non-taxable income limit within the individual category to boost consumption, which is the key driver for economic growth. Coming to the sectors, the sectors like FMCG, education, naturally are in the spotlight as the government continues to focus on its social programs. So, given given the focus on that social issues, government may increase allocation towards agriculture, farm, and other areas, education, etc., which could benefit FMCG companies, which could actually boost consumption and benefit companies like HLL. However, there could be increase in the excise duty for the cigarettes, which could be negative for companies like ITC. In education side also, government is expected to increase allocation towards schemes floated by the government in that area, especially like schemes like Sarva Shiksha Abhiyan. So that would be beneficial for the education players. Coming to other sectors, there could be a withdrawal of the fiscal stimulus given earlier, so that could lead to the rollback of the excise duty. For example, it could be negative for the auto sector as a whole. It could be especially negative for two-wheeler manufacturers like Bajaj and Hero MotoCorp. It could also be negative for the passenger vehicle manufacturers such as M&M and Maruti. Apart from auto sector, the other sector where we have an expectation that there could be increase in the import duty of the power equipment imports, which could benefit the capital good sector. Within capital goods, companies like BHEL etc. could benefit, Siemens etc. could benefit if there is increase in the import duty on power equipment. Apart from that, there could be some announcement towards the easing the import duty on the coal etc. So that could benefit the power generators. Companies like Adani, R Power are likely to benefit from there. The other sector where we have expectation is that is banking. We expect government to continue focus on recapitalizing the banks to boost the lending, which is important for economic growth. Also, in view of the implementation of Basel III norms, capital requirement for banks will increase. So, PSU banks, which are the major recipient of the government capital, should see some some fresh recap programs by government. Apart from that, market will also, as regard to banking sector, market would also look at the government borrowings. If they are higher than the current fiscal, then it could have a crowding out of the private investments and would actually impact the credit growth of banks. However, there is a wild expectation of debt waiver scheme kind of things to be announced. If that happens, that could be negative. Otherwise, for banks, announcement should be kind of neutral. Apart from that, other sectors we do not have major expectation except for logistics, where government can make some announcement on the dedicated freight corridor, which could benefit the logistics companies. So overall, with respect to sectors, we see some development, some announcements for coming for power companies, which will be most likely positive, and negative for the auto companies. Overall, we maintain a market view. As we have released a market strategy report a few days back, we maintain that the market is in the consolidation phase. The election results are already out and they are broadly in line with our expectation. So we believe that markets would continue the consolidation phase, would digest the gains which has happened in past few weeks, and then probably go up. Thank you.